The U.S. market is closed for the weekend, as it is Saturday, November 15, 2025. The last available data from yesterday's session, Friday, November 14th, shows Bitfarms Limited, ticker BITF, closed the day at 2.58 USD. This was a modest dip of 0.77% on the day, but that small move masks the extreme volatility and the fundamental shockwave that just hit this company. In after-hours trading, it did tick up slightly, reclaiming 1.55% to sit at 2.62 USD. If you've been holding Bitfarms, you probably looked at your portfolio on Thursday and felt your stomach drop. The stock absolutely cratered, falling nearly 18% in a single session. The common expectation for this stock, the entire reason most people own it, is as a simple, high-leverage play on the price of Bitcoin. You buy it, Bitcoin goes up, your shares go up more. That has been the narrative for years. But the reality of what is happening right now, the reason for that crash, is that Bitfarms just told the market it is no longer a Bitcoin miner. That's the insight you may have missed. This is not just a bad earnings report, though it was that too. This is a five-alarm fire drill, a complete ground-up corporate transformation announced in the middle of a market panic. Bitfarms is exiting the Bitcoin mining business. The company that defined itself by its hash rate and its Bitcoin per day production is winding down those operations entirely over the next 2 years. The market, which hates uncertainty more than anything, is now trying to figure out what this company even is. The entire investment thesis for 99% of its holders was just invalidated in a single press release. So when you see that 18% crash, it wasn't just a response to the numbers, it was a mass exodus of an entire class of investor who signed up for crypto exposure and are now being handed a high-risk venture bet on a completely different industry. Let's start with the catalyst for the crash, the third quarter 2025 earnings, which were released on Thursday, November 13th. They were a profound miss on every critical metric. The consensus expectation was for a loss of about 2 cents per share. Bitfarms delivered a loss of 8 cents per share. That is a 300% negative surprise. It signals to the market that not only are analysts' models wrong, but the company's internal cost controls or revenue generation are wildly different from what was being projected. On the top line, revenue was forecast to be around $88.7 million. The company delivered $69.25 million. That is not a small miss. That is a 22% shortfall. This combination is toxic. It shows declining revenue paired with an inability to manage costs, leading to a much larger loss than anyone had priced in. This report alone would have been enough to justify a massive sell-off, but it was what management said on the earnings call that changed the game. Alongside this dismal report, CEO Ben Gagnon laid out a new future. He announced that Bitfarms is pivoting, moving to shutter its Bitcoin mining operations and repurpose its infrastructure for high-performance computing, or HPC, and artificial intelligence data centers. The first facility to be converted will be their 18-megawatt site in Washington, which they are targeting for completion by December 2026. This new facility is being designed specifically to handle next-generation hardware like NVIDIA's GB300 GPUs. The CEO's claim is ambitious. He stated that converting just this one site, which he notes is less than 1% of their entire developable portfolio, could potentially produce more net operating income than we have ever generated with Bitcoin mining. He's trying to sell the market a new story, that the real value isn't in mining crypto, but in owning the power and infrastructure that the AI industry is desperate for. He's painting a picture where the US is the best market for AI, while Bitcoin mining can be relegated to cheaper, higher-risk jurisdictions. To fund this colossal shift, Bitfarms has been raising an enormous amount of capital. The company just closed a $588 million convertible senior notes offering. This is on top of converting its debt facility with Macquarie into a $300 million project-specific financing deal to build out its new campus in Panther Creek, Pennsylvania. As of November 12th, the company reports having $814 million in liquidity. So the bull case is that Bitfarms saw the writing on the wall for Bitcoin mining, the high competition, the energy costs, the post-halving margin squeeze, and is now using its massive war chest to pivot into the hottest sector on the planet, AI infrastructure. The expectation is that this cash will be enough to build a new, more profitable business. The reality is that this is one of the most difficult, capital-intensive, and competitive pivots a company can attempt. And that brings us to the bear case, which is loud and compelling. Zacks Investment Research currently has a rank 4 sell rating on the stock, and their reasoning is a cold dose of reality. They point out that Bitfarms is not entering an empty field. They are walking into a war zone where the incumbents are giants like Marathon Digital and Riot Platforms, which have a significant head start, higher market caps, and are already leveraging their mining infrastructure for AI. Bitfarms has no first-mover advantage here. Furthermore, this is a business of staggering costs. The technology, like the NVIDIA GPUs they plan to use, becomes obsolete incredibly fast. Zacks highlights that the energy density for these racks is already climbing, meaning data centers built today could be incompatible or inefficient in just a couple of years. This creates a constant, draining need for more capital to stay competitive. And the stock is, by some metrics, wildly overvalued for a company losing this much money. Zacks notes its EV to EBITDA ratio is over 103, while the industry average is closer to 15. The market is still pricing in some of the crypto hype, even as the company itself is running away from it. Before we get into the short interest, comment below. Do you think this pivot to AI is a brilliant strategic move or a desperate attempt to flee the mining business? Now, let's talk about the real battleground for this stock, the short interest. This is where the story gets incredibly nuanced, and it's something you need to understand. When you look up the data on a platform like Fintel or Ortex, you'll see a very high short interest float. As of the latest data, it's hovering around 17.69%. That means nearly 17% of all the shares available for trading are being held by investors who have borrowed them and sold them, betting the price will go down. This is a significantly high number and shows a deep lack of conviction in the company's future from a large portion of the market. But here is the critical piece of data you must look at next, the borrow fee rate. For Bitfarms, the cost to borrow a share is currently just 0.83%. That is extremely low. Let me explain what this combination of high short interest and low borrow fee actually means. It means this is not a crowded retail meme stock squeeze. When a borrow fee is high, it means there are very few shares left to borrow, and short sellers are in a panic, fighting over them. That's when a squeeze can happen. The low fee on Bitfarms tells you something different. It says that while many institutions are shorting it, it is an easy, cheap, and non-urgent position for them to hold. They are not worried. They are not in a panic. They are calmly placing a fundamental bet that Bitfarms' new AI strategy will fail. They're betting on the Zacks thesis, that the company will burn through its $814 million in cash, that the debt load from the convertible notes will be too much, and that the competition from Mara and Riot will prove insurmountable. This is not a short squeeze play. It's a fundamental disagreement with the company's entire new identity. When you look at the fail-to-deliver data, you can see spikes in October with over 1 million shares failing to settle on certain days. While this is a lagging indicator, it shows that in the recent past, there have been settlement issues and significant volatility in the stock's plumbing. What's your take on that high 17% short interest? Is it smart money seeing the execution risk, or is it just fear of the pivot? But the story gets even more complicated when you look at who is buying and selling. This isn't just a simple shorts versus longs story. The latest institutional filings from the last quarter show a complete contradiction. On one hand, total institutional ownership has increased. There are 219 funds now holding the stock, a 23% jump from the prior quarter. And the total number of shares they own has ballooned by 65%. Major players like Jane Street, Susquehanna, and Citadel all massively increased their positions. They're clearly buying into the bull case, a cashed-up company pivoting to the hottest sector in tech. But here is the most telling move of all. Riot Platforms, Bitfarms' direct competitor, was a major shareholder. And in the last quarter, Riot dumped 35.68% of its stake. This is an incredible signal. A direct peer, a company that understands the mining and data center business better than any Wall Street analyst, is selling. They are getting out. This is an incredible vote of no confidence from an industry insider, happening at the exact same time that hedge funds are piling in. So, where does this leave the stock? The future of Bitfarms is no longer tied to the price of Bitcoin. That expectation is gone. The new reality is that this is a high-risk, high-debt, speculative bet on a corporate transformation. The bull case is that Ben Gagnon is a visionary, and he's using $114 million to build a cash flow machine that will lease high-demand AI data center space. The bear case is that this is a company in crisis, fleeing a business it can no longer compete in and entering one where it's already years behind the leaders. The stock price is now a battlefield. On one side, you have the new institutional longs like Jane Street and Citadel. On the other, you have the entrenched fundamental shorts betting on failure and a major competitor, Riot, that has already run for the exit. Bitfarms is not the company you thought it was last week. The entire narrative has been rewritten. The stock is no longer a simple crypto proxy. It is a venture capital bet on an executive team's ability to execute one of the most difficult pivots in the modern market, funded by massive debt against deeply entrenched competition. The fight between the new longs and the fundamental shorts will define this stock for the next 2 years.